Welcome to Hidden Framework. This channel explores the systems that quietly shape everyday life in America and the United Kingdom. If you want to understand how money, policy, and power truly operate, you're in the right place. Every year, millions of Americans are judged by a number they rarely think about, a number that can determine whether they buy a home, finance a car, or even rent an apartment. It's called a credit score, and most people don't realize how deeply it influences their lives. Today, we're breaking down how the credit system really works and why it was built this way. A credit score is a three-digit number. It typically ranges from 300 to 850. It is designed to measure how reliably you handle borrowed money. But here's what many people never consider. It isn't just about borrowing, it's about risk classification. The higher your score, the less risky you appear to banks, lenders, landlords, and in some cases, even employers. In the United States, the most widely used scoring model is known as FICO. Your score is calculated using 5 primary factors. Payment history accounts for 35%. Amounts owed 30%. Length of credit history 15%. Credit mix 10%. And new credit inquiries another 10%. Miss a single payment. Your score drops. Use too much of your available credit. It drops again. Apply for several credit cards within a short time frame. It drops even further. Over time, this system begins to resemble behavioral tracking, disguised as a financial measurement. The modern credit scoring system became widely adopted in the late 1980s. Before that, loan officers made decisions manually. That often meant bias, inconsistency, and slower approvals. Credit scoring changed that. It automated risk assessment. Banks embraced it because it allowed them to price loans based on perceived risk. Higher risk meant higher interest rates. Lower risk meant better borrowing terms. Over time, this created a tiered financial structure. Two people can earn the same income, but if one has a lower credit score, they may pay thousands more in interest over a lifetime, not because they earn less, but because they are categorized as higher risk. And the influence doesn't stop with loans. Your credit score can affect mortgage approval, car financing rates, insurance premiums, apartment applications, utility deposits, and, in certain industries, even employment opportunities. A lower score doesn't just mean higher interest, it means fewer options, and fewer options mean less financial flexibility. There's also a psychological dimension. People avoid closing credit cards, even when they no longer use them. They maintain small balances to appear active. They hesitate to apply for new credit. Out of fear, their score might decline. Gradually, the system shapes behavior. It rewards participation. It rewards structured debt management. But here's the hidden reality. Credit scores do not measure wealth. They measure how effectively you manage debt. Someone with no debt at all can have a lower score than someone managing multiple loans flawlessly. The system does not reward independence. It rewards controlled participation. Now, this doesn't mean the credit system is malicious. It is efficient. It standardizes evaluation. It reduces certain forms of human bias. But understanding it gives you leverage, because once you understand the framework, you stop being passively shaped by it, and you begin navigating it strategically. This is Hidden Framework, exploring the systems that shape your life.